but my last name is PH.
Hello. Okay. Good timing. This is Howard Klein. You're watching CRE TV Live, and today we're going to give a CMBS update. We're even going to explain a little bit what CMBS is. We're going to give a little bit of historical nature to it and then compare it to what a CLO is, which is not, in this context, a chief legal officer, which on one occasion I was a chief legal officer. So we're going to talk about what's going on in the marketing, special servicing, workouts, and asset management. Today's panelists are Jyoti Yadav. Jyoti, I'm sure that I butchered your last name, from Trepp. Shlomo Chopp, CEO of Case Equity Partners, and Stacey Stack-Rudolph, who will make sure that I misspelled her last name, but Stacey was a last-minute fill-in. I'm Howard Klein. I've been a California licensed attorney for over 44 years now, with a special emphasis on commercial landlord-tenant matters, lease negotiations, evictions, rent collections, and foreclosures. So why don't we move on now? Oh, let me just mention one more thing. We are not giving legal advice. You're free to give any of us a call or to contact us by email if you need some help or advice. But if it's a legal matter, you need to consult your own legal counsel who's qualified to give you advice in your jurisdiction. All right, let's go on to our panelists. Well, we've got Shlomo Chopp. Shlomo is the managing partner at Case Equity Partners, which is a real estate advisory firm specializing in restructuring, turnaround, and management of distressed real property assets. I suspect that Shlomo is going to be getting very busy over the next 2 years. Shlomo and his team are strategic thinkers. I love that reference to strategic thinkers, and hopefully he'll tell you a story during this panel discussion about how he comes up with his strategies. He empowers lenders to accept his custom-crafted structuring plans. Gives a lot of thought to it. Next is Jyoti Yadav. Jyoti is an analyst at Trepp, specializing in CLO or CMBS market. She is a leading contributor to Trepp's research and analytics. She provides key insights to the industry, media, and other external audiences, including as a guest on multiple podcasts. Comcast podcasts. She is a regular contributor on Trepwire podcast and has appeared on the real estate syndication show with Whitney Sewell. So that's a reach out and applause to Whitney. So hopefully he'll come back and ask me to speak on his show. And by the way, Jyoti has been on my show once before. And then we have Stacey Stack-Rudolph, which I understand now is spelled Rudolph. Is that correct, Stacey?
Yes, sir. Like the reindeer.
Okay, so that just shows you what I know. So Stacey has over 20 years. She doesn't look like she's got over 20 years of commercial real estate and capital market experience across an array of functions, including underwriting, asset management, loan servicing, portfolio reporting, statistical, financial analysis, risk policy, and systems development. I really got to learn how to say that fast enough, and then I can be on a Gilbert and Sullivan live theater, because they talk really fast. She holds a BBA in finance from Southern Methodist University and an MS from University of Texas at Arlington. All right, so now let's move on. Oh, there's me, and I don't have to talk about me anymore. So let's go now to the panelists. This is going to be by the way, let me just introduce everybody. Jyoti is in the upper right-hand corner. Stacey is in the bottom left-hand corner. And I guess that leaves Shlomo in the bottom right-hand corner. Sorry, Shlomo, you got the worst location. I didn't do that intentionally. It just worked out that way.
As long as I'm across from you, we're good.
Oh, there you go. Uh, uh, Bathtub? Did you say bathtub? That's an inside joke. We're not going to get into that. Okay, so why don't we start out with? Were we going to start out with you, Shlomo, talking about the historical perspective, or are we going to have Jody just explain what CMBS is? I
Yes, I'll
forgot.
I'll I'll give a little start, and then Jody will get technical.
Great. Let's go to
So,
you then.
or well, Jody will explain the technical. So, often I talk to borrowers. I work with borrowers that have properties that are in distress, and they always harken back to the days of the RTC, to the savings and loan crisis, and they're able to buy loans for pennies on the dollar, and often feel and have felt certainly in the last downturn that they could get deals from lenders at a good discount because, hey, why do they want it? And if you track that back a bit, the whole concept of CMBS came about as a result of the RTC, the crisis that brought about the RTC. And the RTC was the first example of, well, probably the first example, Jody could correct me, of a CMBS like structure. What happened was all these savings and loans banks across the country made loans and they went bad, or many of them went bad, and they had issues with the FDIC, with the Treasury, with regards to cash balances, and they had to get rid of it. But no one wanted to buy it at semi decent prices in their eyes. So they would sell it at extreme discounts, and a lot of people bought them up and started their career in real estate at that time and made a lot of money. Well, after a while, the government sort of got fed up with the stuff selling very cheap and recovering very little for the taxpayer or for the FDIC, and they created this concept where they would take the cash flow of the real estate and turn them into bonds, and if they become credit rated bonds, they could be sold to investors that never heard of real estate before, never dealt in real estate before. And that was the approach that they took, and they established along the lines of a REMIC, which Jody will talk about. So that crisis turned into CMBS, that became an accepted form of securitization, which unfortunately led us to the last crisis, when just the RMBS and some CMBS also just over levered, and to a certain extent led us to an issue now with the COVID-induced crisis because of the inflexibility that comes about when you work with investors in a bond that have a set specification as to how you deal with it. So I just wanted to connect that little history for anyone on the real estate side so they could understand how CMBS came about. But when it comes to the technicalities and the bonds, Jody, please.
Well,
Thank you, Shlomo. That was very helpful. And Howard, if you don't mind, I'll just start right away. Just for people, just to get the basics out of the question here, banks which originate loans on commercial real estate assets. What ends up happening is a bank is not just originating one loan or two loan, they are originating a lot of them together. And what they would do is instead of keeping them on their balance sheet, they would pool all of these loans together and, and securitize that. And once these are securitized, the bonds are sold to investors. And as Shlomo was mentioning, it's to people sometimes who haven't heard about commercial real estate or don't are not knee deep into it. And all that matters to those investors is they're getting a 10-ish year fixed rate bond, and they are able to they get like a constant interest from that on a regular basis. Whereas for banks, they are able to offload the risk of holding these loans on their balance sheet, and they are also able to pocket the origination fee in the process. So it works as a win-win situation for both the parties. Investors are able to get like a 10-year fixed rate investment, whereas banks are able to make loans across all sort of commercial real estate assets. Now, now, as Shlomo was mentioning, it started like back in the day for a particular reason, but the structure itself is very strict. How the cash flow flows from the borrower of that loan to the investors, there's a particular path and there's a particular process, and there is not a lot of flexibility available in the market. Well, until now, until what happened with COVID. So, and we will get into that later, how the CMBS market has responded differently in the current COVID environment. But that is something that was kind of a negative point, that the structure is very, very rigid. And I hope that helps. Let me know if you have any questions to that.
Well, I have a question. So, if I'm an owner of a shopping center and I need to borrow money, do I go, here's an option, maybe I can get a CMBS loan? Do I go to a bank? Do I go to an insurance company? I mean, how does, or is it that I go to a bank and all of a sudden I'm, being serviced by a servicer and it's part of a CMBS tranche? What's the deal with that?
Well,
Right. So
that's
go ahead,
I
Stacey. I
was
think
going to
you.
say that's kind of my background. That's I do a lot of underwriting for different channels of origination, whether it be CMBS lenders, bank and life insurance companies, or advising the B pieces and the purchase of those bonds. And so you're right, Howard, with regards to the pricing. I know I've spoken with several players in the smaller space that we find that CMBS, and Jody, you can talk about this, is a bit more aggressive beyond some of the recourse triggers that there might be. We find that it's hard sometimes for some of those banking regional banks or smaller players or even life insurance companies to take the level of let's just say risk on an asset in pricing, as well as structure that you can sometimes see with the CMBS market. What do you guys think?
Oh, right. That is definitely like a valid point, Stacey, as you were saying. So I would define it as something like life insurance companies. They generally give out to loans to trophy assets whose cash flows, are very stabilized. They know that they perform very well. Uh, I think in the CMBS market, that ends up kind of covering, non-trophy assets like not A-class malls sometimes, but B-class, B and C. It is kind of I would say it's kind of the place where everything else, like all other sort of CRE loans, which banks and insurance companies are not keeping on their balance sheet, end up going to, if that makes sense.
I
No.
think we've seen that with that's one of the questions that comes up. And many times some of the B piece buying is, I think we talked about something not too long ago with mobile home parks and multifamily or self-storage. If you see a multifamily outside of the agency securitization platform today, it makes you kind of scratch your head. If you
Yeah.
see something that is a trophy asset, and there have been a couple that have come to market, are they coming because they can split that and receive more proceeds and split them across securitization transactions to get what they need as far as proceeds go? Or maybe, again, a little bit less in reserves. Sorry, Howard, I didn't mean to cut you off.
No, that's fine. So, Jody, what's the difference? On your website, it says that you're a CLO/CMBS analyst. What's the difference between CLO and CMBS?
Right. So CLO is essentially collateralized loan obligation. So now TREP, while it operates in the CRE, CMBS market, we also operate in the CLO market. And I would like to differentiate that in the CRE market, there is CRE CLOs. And what TREP also covers is CLOs in the corporate market, corporate loans. So CLOs made out of corporate loans. So that is something also I cover. But for the perspective of commercial real estate, CRE CLOs actually have do not follow the same REMIC structure the CMBS follow. They have a different tax structure, and they can also be extended like CMBS. CMBS generally is 7 to 10 year loan, like a deal which is securitized there. CRE CLO, on the other hand, can be extended and restructured a number of times. Typically, you will see those are much smaller deals whenever you see them in that database. And one very important thing is most of the times when we see CRE CLO in our database, that is when when let's say the borrower is trying to significantly improve the cash flow of the property, and it's kind of a bridge loan, like they are trying to remodernize a multifamily asset, and they would use this, and after they are able to like overhaul or renovate the property, they'll be charging much higher rents, and that's where we have seen CRE CLO loans used most of the times.
Great. Unless anybody has anything to add right now, I'd like to get into what's going on in the market right now. That's the CMBS market, and how that might differ from the rest of the finance market. And I'm assuming that Shlomo and Stacey are just going to, and feel free to jump in and give a story or comment. So, Jyoti, why don't you start us out with what Trepp sees as what's going on in the market, and perhaps what you see will go on in the market, and how that differs from the rest of the finance market.
Right. So, well, uh, everyone knows that because of COVID, commercial real estate has been drastically impacted. But it is very important to know what sort of property type you are operating in or you are looking at, because the performance has been drastically different. So lodging and retail, especially lodging, let's talk about that. Lodging CMBS loans have seen a lot of distress, and followed by retail. So there are two criteria that TREP generally looks at to identify how much distress is there in the market. First one is delinquency rate, which is essentially when a borrower is more than 30 days behind on their payment. That is when the servicer will report back to TREP database, and we try to analyze that data on a monthly basis. So what we saw, and Howard, you were aware because we spoke about it last time when I was on your podcast, is in in June, the delinquency rate went as high as 10.32%. That and TREP tracks over $500 billion worth of CMBS loans. So this is a drastically high number, because in the last financial crisis the number was 10.34%. So what happened? What took 4 years for the CMBS market. How much distress happened in 4 years in the last financial crisis? That happened in a period of 4 months this time around. So that was a really big jump in the delinquency rate. So now, since then, it has reduced a little by little every month. I think June, end of January, we saw a delinquency rate of 7.58%. While that is a very good improvement, that there is less distress in the market, that is nowhere near where we were before COVID. Because before COVID, it was 2-ish%. So that is still almost 4x of what we had before COVID. So that is one thing that we have been noticing in the market. And the very important thing is that industrial property types, delinquency rate is actually going down. These property types are actually performing much better. Whereas if you see lodging, we reached a high of almost 25% in the summer. While that has reduced too, it is almost at 19%. That is still very high. That's approximately like 18 to $20 billion worth of loans, which are behind on their payment. And I'll also talk about the retail sector, and I'll just go through the numbers again. And retail sector is kind of interesting, and Shlomo probably will add more on that later. The fact that that sector was already seeing a lot of distress before COVID, just because not a lot of people were going to malls. We still got used to ordering everything on Amazon. So the number was approximately like 4% before COVID, and that went as high as 17% end of January. That's the number we have end of January. It was highest was 18%. So I like to quote these numbers because this is something that none of us working at TREP would have ever thought that we will see numbers this high ever. And within a period of few months, it just the distress is really everywhere, especially when you talk about lodging and retail market.
Wow. Yeah.
I actually,
Go
if you
ahead,
don't mind, I
Shlomo.
have a question for Jyoti.
Mhm.
So when you say delinquent, does that include a less than 30 days late? Does that include 30 days late? Does that include someone that maybe is current but is under a forbearance and deferral agreement? What are the parameters to those percentages?
Right. That's a very good question because that is something TREP has been looking at for quite some time. So it depends. So delinquency in our database, these numbers that I quoted, is that the borrower is more than 30 days behind on their payment. We have seen forbearance agreements in the CMBS market. In fact, a lot of those, which prior to COVID, no one like those things just did not exist. But whenever we have seen forbearance agreements being executed, in those situations, what ends up happening is most of the times the borrower is allowed to use their reserve balance to make monthly payments and catch up on their missed payments. So in the situation where a forbearance agreement has been executed, most of the times the borrower would not be behind payment. So I would say that this delinquency rate is essentially when, even if there is a forbearance agreement, either they have not been able to catch up on their payments, or there is just no forbearance agreement. So that's how I would define it.
Well, and one of the
Interesting.
things
I'd
that
like
TREP, that I was going to say that TREP tracks that Jyoti, I know it's not it, is that the guys go through and scrub those. There's a code that TREP captures from the reporting package that they've done a great job of scrubbing and putting together lists of those loans that have gone through forbearance. It's interesting that you highlight. I think Shlomo's about to go there. That doesn't mean that all they are doing is taking the cash reserves that are meant to preserve that property in a distressed situation. Sometimes hotel loans that have property improvement reserves, and they're using it to fix what is thought of as a temporary problem. What we're seeing is that now here we are a year later, and there's actually further repercussions. And I think Shlomo, I'll segue to you on that. Is that some of it is not quite as temporary, and it roots back to the way that they were underwritten to begin with, and that basically we hit a little bump in the road, and maybe it's even being masked by a COVID code or a delinquency that looks like it's current when there's really no cash flow coming in. So it goes back to the root of that financial reporting as well. So with that, segueing to you, Shlomo.
Yeah, you see me about to jump over here. That's great. So I'm gonna do my best Paul Harvey. I'll give you the rest of the story, and I'll give you guys some insight that unfortunately is really not reported. Well, maybe fortunately it's not reported, but it's really a pressure point in the market, and I think hopefully we don't see the effects of it. So let's talk about COVID for a second. In some instances, COVID took a perfectly healthy sector, for example, hotels, and demolished it. Just there was no reason that hotel should be as bad as it is if not for COVID. Okay. In some instances, it took very healthy properties in every sector, office, retail, and it demolished it. No question. But that effect was to a certain extent COVID. But in some sectors, it's like hot sauce. They say you put hot sauce on the meat, you taste it much better. It doesn't really have its own taste. That's what COVID was, and COVID exposed a lot of underlying issues. The retail industry, I bet you the mall companies felt that they have more time to figure things out before it hit them, and COVID just sped it out. Now, let's talk about CMBS 2.0, which is CMBS that happened after the last crash, and let's talk about some of the clauses. One of the clauses that we'll put into CMBS 2.0 that is that's lesser known, and that is a non-interference or anti-litigation clause. And essentially it reads, depending on how good your attorney was, if your attorney was really not that great, or you had a very strong lender across from you, it says that if you respond to a foreclosure filing, you trigger full recourse on the loan. It essentially expects you to not respond to a foreclosure, and therefore you'll get a default judgment and have a good day, and they could take the property. That is the worst case. In the best case scenario, it says that if you file any type of unreasonable response or attempt to prevent the lender from taking back the property, then you trigger full recourse on a loan. Now let's realize CMBS debt, one of the most attractive components is the non-recourse component of it, right? Obviously you get some more proceeds in other ways, but non-recourse. So literally, if you defend yourself, you've lost that component. Now, Howard, you're going to say that's against public interest, aren't you?
No. Actually, I wanted to clarify something because some of my audience are not as sophisticated. And when you're talking about recourse or non-recourse, you're talking about recourse to an individual. Are you not?
Yeah.
Yeah, okay.
Yeah, so the loan is always...
you might have an LLC that owns the property, and that's the borrower. You have a servicer, has to look to the LLC, and then there's the individual who perhaps guarantees the loan, but only in certain events. And what you're saying is, should anybody resist a foreclosure or oppose it in any way, guess what? It was a non-recourse. Now they can go after the individual or individuals. That's what you're talking about, correct?
Exactly. The difference between a non-recourse and a recourse distress loan is if you took a loan on a property of $100 and it's worth $50, you don't do anything in court. You lose your property that's now worth only $50, and the debt is more than that. If you then go and violate that carve out, which means you violate that clause, you're now on the hook for the remaining $50 that the lender is now going to lose. It's very simple like that. Now, let's take the next step. We've spoken about forbearances, and Jyoti pointed out that these forbearances and deferrals are not included in the delinquency rate. So when we talk about a 18% retail distress rate, that does not include any retail property that received a forbearance/deferral. Okay, what is a forbearance? A forbearance essentially says, hey, you're in default, but we're not going to pursue you if you agree to a following new payment plan under a deferral, right? That's when it's combined with a deferral. The lender will forbear from going after you in court if you agree to a payment schedule. If you don't make that payment schedule, then the default starts from the day you started. So you'll start off, let's see, if you got a 6-month forbearance, you'll be 6 months late by the time you start. More recently, 12 months has been more in vogue. We start from there. Now, what's this whole forbearance deferral? Last time around, we didn't really see much of it. Well, when the whole market implodes the way it did, and in CMBS, there really isn't a quick, easy way to modify a loan. And it could take, I did a modification, took 3 years. It could take 8 months, 9 months, it could take a year. If you're in such a situation, by the time they figure out what they want to do, it's Armageddon. So they needed a quick fix. Some lawyers got together, found a loophole, and said we could give a forbearance without even a transfer to special servicing, which means that I'm even getting into the right department. I'm leading up to something here, Howard, extremely important.
Oh, I'm not timing you.
I'm timing
the show overall.
It's coming. Okay. So what's happening is that they are now giving these forbearances that otherwise isn't on the documents, right? But here's the thing. Almost, I'd say probably 90 to 95% of forbearances requires that the guarantor of the loan guarantees the money that they were forgiven during the forbearance period. In other words, the deferral, personal guarantee. So if, let's say their payment is $100,000 a month, they don't pay for 12 months, they now have $1.2 million personally guaranteed. And depending on how tough the asset manager is, you've given a confession of judgment of foreclosure. Okay. Plus, you've sometimes given a waiver of stay in bankruptcy, which means in commercial real estate, the only thing that could stop a foreclosure is a reorganization. Now, that would trigger recourse. And is a bankruptcy would trigger recourse, which would again give you a personal guarantee. But in some instances, you actually give a waiver of stay of bankruptcy. You can't even stop the foreclosure. So you have a confession of judgment and a waiver of stay. Some attorneys say it's against public interest, but here's what happens. What happens is that if by the time the forbearance is over, 12 months from now, it's a cliff. Boom, forbearance is over, we're foreclosing down. Now I won't say hotels because God willing it comes back, but that retail 18%, I don't even want to speculate. Okay, so the point is, this is a house of cards. Now here's where I think the special servicing industry has an issue, and it's no one person's fault. No one wants to be the sucker that gave that mod during COVID, right? Even if the property really needs help, you don't want to do it immediately. So you're essentially going to not do much except give a guy a forbearance deferral, take your pound of flesh, because you're never going to give something for free. It's bad for you. The rating agencies may or may not like it. The investors may or may not like it. Hey, this guy, well, he cashed out money. But at the end of the day, what the lender side of the business is not contemplating, or they are and really don't want to on a one-off acknowledge, is that if they don't get proactive, which they won't, it's going to fall off a cliff. And it's very hard to explain this to bank on a one-off, because if you tell me if I do my part to push off global warming, then it'll help the world, I may or may not do it because I'm just one guy. But if we all did it, it's something else. But get everyone in a room and do the opposite of what happened at origination. When you took the loan, I'm finishing here. When you took the loan, everyone wanted to give it. No one wants to forgive it now. So get them to agree on forgiving. It's an issue. So you can argue all you want. It's an uphill battle. I could talk about how we get there, but I think I've talked out and I yield whatever is not remaining of my time.
No, Shlomo, you were great, and I relate this to, because I deal primarily in the landlord-tenant world, and what you're talking about is exactly what we're doing. The landlords are, well, we call it rent deferral, but in essence, they're forbearing, and they're just pushing everything down the road, hoping that the world will be a better place in 3 to 6 months, and not worrying about it. The problem is on some of these deals that, the tenant is going to have to pay back. They're not forgiving rent for the most part. They're just deferring it, and all of a sudden the tenant has got to not only start paying rent, but then they're going to have to start paying back the rent that was deferred. And I don't know. We did a webinar last week with Ken Lammy, and Ken was talking about saying you got to look at whether or not it's reasonable for the tenant to be able to pay all of that back. You're going to fall off a cliff in a lot of these situations. I don't know.
The difference is if you're a landlord, you can make snap decisions. If you CMBS,
you can't.
The default is foreclosed. You're allowed to modify. So, and the asset manager is not incentivized to do hard work to save money for the BP solder, and he can't even prove that hard work will end up in a positive result.
I think that's the other thing we're forgetting, just that came to mind, is when we underwrite these deals as a B-piece buyer, they are not underwriting everything as 100% no default ever during the term or at refi. And so, when I'm playing the role of special servicer, my job is to, of course, maximize proceeds to the trust. And, I think there's concerns about, timing of those payments and such, but we still have to come back to maximizing, the impact on the trust and how that plays into the CMBS realization of loss and the control piece. And I think that's the other thing that we saw changed with CMBS 2.0 is that the loss is realized faster in the sense of the change of control. And so, speaking back to that, Shlomo, it might be worth, or Jyoti, about talking a little bit about that and how, it's really interesting. I use TREP all the time to monitor how those bonds are rolling and what's projected and how that one case may change or may incentivize or de-incentivize somebody or a committee to say yes or no. And how the different, like you guys have already touched upon, diversification of pools and property types, or even across the United States, geographically, can impact the way that the loss runs are going to happen.
Yeah, Stacey, do you want to explain it with BP's buyer? Because I said it a couple of times, and it's just explain the process.
So, and y'all correct me if I'm, if I get too sophisticated or lack thereof. But a BP
Let me just stop you there a second. You went to Texas, school in Texas, right? So that's where
yes,
the y'all came from?
correct, correct.
Okay.
I'm sitting in Dallas now, so
Oh, okay.
yeah, I'm in, and we're a pretty big servicer capital besides Kansas City. So we've got a lot of special servicers that are, again, my buddies and friends that I grew up with, cut my teeth with. And then we were the BP Spire as well. And what do I mean by BP Spire? Well, as Jyoti and Shlomo talked about, when these securities, so we have a loan is made, the loan is packaged with 200, let's just pretend it's 200, a larger group of loans, and then the rents that come off the properties go to pay the loans by the borrowers, and then the cash flows that come off of the borrower and the loans go into a waterfall that pays typically top to bottom a series of bonds. The top are triple A rated typically, and it flows all the way down to what we call the B piece, which is basically the lowest bond. So if somebody doesn't make a payment on the tenant side and ultimately, a loan is not paid, well, the waterfall that pays down that CMBS structure is impaired. Somebody doesn't get paid, and it's the lowest guy. So at the beginning of a deal, when a deal is coming to market, that they put out the bids and says, who wants to play in this pool? Who wants to bid on this pool as a BP Spire? So, sometimes it's awarded, sometimes there's 2 or 3 guys bidding, and those guys get to look at every single loan and re-underwrite it. Look at all the documents, look at how that originator made that loan. And if they believe that those assumptions based upon the market, the performance, actually what I call my 5 pillars, the market, the property, the sponsor, the tenants, and the structure. And if they believe in those and they underwrite whether they believe that they're going to receive ultimately in packaging 50 cents on the dollar, 90 cents on the dollar. And so when we talk about being impaired and why it's so important for many times those special servicers are part of this, we're talking about, again, is it going to default during the term, or is it going to default at refinance? What's going to trigger, or is it not? And those assumptions are what the special servicer is ultimately trying to beat for the BP Spire, because they're the ones that interface once there's a credit issue at hand. And they're the ones that have to package it up and make the recommendation. So when you're going to the guys, that have hired you to make the maximum recovery, and you're having to say to them, well, geez, guys, this is defaulting earlier than we thought, which this whole market, was a shakeup with the pandemic. You had a tsunami of defaults happening. Like Shlomo said, they don't want to be the guy that says, you know what, even though everybody thinks it's temporary, we're going to make a permanent write down on this, or we're going to split this into an AB permanent modification for the remainder of the term. They're much more likely to, especially in the beginning, have something, underwritten that says, hey, this is a temporary impairment. Now, there's some other more nuanced things about what happens when a loan defaults, and, the bring in things like appraisal and value and write downs and such. And, I'm not going to go down there unless we all decide to go there. But ultimately, at the end of the day, that's the BP Spire. He's the guy that's saying, I bet 50 cents, I was going to collect 50 cents on the dollar over, 5 years or 7 years or 10 years. Am I achieving that? And that's where the special servicer comes in to try to effectuate that.
This is complicated stuff. So I want to interrupt everybody right now and make sure that before I said this, we're not giving out legal advice, but you should look, if you're in the world of CMBS, if you're a borrower, then you better get a hold of Shlomo and Jyoti and Stacey. So Shlomo, why don't you just cut in now and tell people when they should get a hold of you? We're going to be talking more, but who should be getting a hold of you, when they should be getting a hold of you, and how to get a hold of you. And then we're going to go over to Stacey and then Jyoti to do that. So Shlomo, who should be getting a hold of you, when, and how?
Yes, I hope just listening so far, If anyone is confused, that's just we're scratching the surface. There's so much more in depth and so many more moving parts relating to when a BP buyer loses control and the special servicer changes, and all these things play into how you get to keep your property by convincing the special servicer to actually say, you know what, it's the best possible deal to work with you. So to answer your question, Howard, I would say this. Let's go through the process that a special servicer does. He reviews the information you sent to him, and before he can make any determination as to where he goes, he needs to get a value. He needs to establish what he thinks the value of the property may be. That means he needs an appraisal, okay? And he also goes and solicits broker opinion of values, okay? Now, if you leave that to chance, let me say it again, it's so important. If you leave the appraisal and the broker opinion of value to chance, you've lost your property before you even know it. And what does that mean? The broker whose opinion is solicited does not know your property well, but you probably have a relationship with his shop. You should be educating the brokerage community what's going on with your property. Number two, when the appraiser sends you a questionnaire, you need to fill it out. You need to educate that appraiser as to what's really going on with the property. So let's think for a second. What do you tell the appraiser? Whatever comes to your head in the moment? Well, you got to do it quickly, because if you don't respond in decent timing, you trigger recourse again because you're not complying with the lender on appraisal. By the way, there's all these landmines. So you need to have a plan to turn around your property, because if you want the lender to buy into whatever story you're selling, you need to explain to him why you could turn it around, and he would have a bigger problem. It will cost him more to turn it around. So you need to have a plan. Now, if you know everything that we know, or if you have someone that's an expert in CMBS in-house and not bought debt, not, sold something, or not been I'm talking about understands, has read the PSA, the underlying trust document on the SEC's website, from that for each trust from cover to cover, then you don't need us. But if not, you need us or someone like us. And you need a strategy then. So you need to not only have a strategy with the property, you need to know how that interfaces with the process that special servicer has. I'll tell you that I need about 3 months before I even talk to the special servicer. So I would suggest, if you see a problem coming down the pike, call whoever you feel comfortable calling about this, and don't let it be your origination attorney. With respect, Howard, too many origination attorneys got you into bigger problems than you know about before you start.
I'm not an origination attorney. I'm the guy who represents the special servicer on the foreclosure, both during the foreclosure and after. So you and I are very well could be on opposite sides of the spectrum. I'm not the origination attorney. Don't put me in that.
Never. I'd have to, step away if I was against you. I couldn't do it. But the truth is, if you go to your attorney, don't take his recommendation for a litigator. You need a really good CMBS attorney who could work with us, that can advise us based on our strategy. I don't need the attorney to tell me every day, well, why do you have to do this? It's just simple. I didn't ask you for your strategy advice. I need your legal advice, and I'll do the strategy. And it comes across cocky. That's great. It's because of frustration with other deals.
I couldn't agree with you more. I couldn't agree with you more.
Yeah. So you need to get in touch with us at least. Well, the second you see a problem, let's discuss it. I'm not going to take you to the special servicer too early. I can't. There's only 2 ways to transfer, and probably won't be able to go too early to the special servicer who handles every problem. So you got to get me as soon as you have a problem. Call me. I'll call someone. No one's going to charge you for initial conversation or multiple conversations.
No, I agree. Again, I relate to the landlord-tenant world. If you're a tenant and you're just smelling a problem, that's the best time to call me up. Not until I've already negotiated the deal with the landlord. I just need you to write it up. That's the worst time to get me involved. Absolutely. And so how do people get a hold of you, Shlomo?
So our website is caseps.com. That's CASEPS.com, Case Property Services, CPS. And they could reach me. Our contact information is on it, and we're more than happy to have a conversation and talk more in detail.
Now, Stacey, How do you fit into this picture?
Absolutely.
I
Well,
like hold on. Can I take that?
Yeah, okay.
Can I take that?
Yeah,
I work with Stacey
sure.
on
Wait,
origination of a
okay.
loan.
Yeah, Stacey, he does all
I
the
got it.
talking, right?
Exactly. That's our agreement. So just the way it's going to be. Now, just I want to make this one thing. I dealt with Stacey on an origination, and she was amazing to deal with. She guided me. I'm not going to go into detail, but when this picked up, and when I saw it picking up early on in COVID, and Stacey has her own business doing, she underwrites for BP's buyers. There's a lot of underwriting. I said, Stacey, I need your help. I need your help because I need someone who understands all this at my level. And there aren't that many people out there who understands from this side. And I told her, come on board. And she agreed to come on board. And she's been a godsend to me because I couldn't do it otherwise. So she wasn't going to say that. I will. So that's why I interrupted.
All right, Stacey, now you can
Thank you.
now you can talk.
Well, like Shlomo highlighted, I think where I saw a real need in our universe was about 6 years ago. I'd done a lot of touching of things with BP buying, and then I moved to the distress side, and through that I used tools like TREP to really help make my teams and make myself versed. By no means are we all knowing. We all have things to learn every day, and that's where you make the errors if you pretend to know more than you do. But I do a lot of advising to investors. I do advising on the origination side. I work on, I shouldn't say my team works on transaction cases. We work with everyone from the borrowers, just a one-man show borrower, to large corporate borrowers, to special servicers when they're, again, assisting those B-piece buyers. We've worked with B-piece buyers directly as well. As Shlomo said, the way I got involved with Shlomo was on the origination side, and we'd always looked for a way to work together because I like his methods. And the reason I like his methods is, as much as there's a strategy behind a workout, it's really just another way to look at structuring and underwriting. And I saw some things that started to happen in March, especially on the hotel front. And I saw borrowers that knew what they were good at operating their properties, but I didn't see borrowers that knew how to talk to servicers. And part of our world is making the lives of the asset manager, as much as in the workout case, you're on the other side of the table. It's making the market efficient and working with them so that when they build that case, it's not like they're having to recreate a wheel, especially when, again, there's a wave of defaults coming over. And I immediately, he called me, I think, before I had a chance to call him. And I said, Shlomo, I need somebody that borrowers that I know can work with, and somebody that I believe in, that I can feel confident with my servicer colleagues, and then kind of coming back full circle, kind of to Jody's, this is not the TREP show, but I love TREP. I have worked with TREP for, about as long as the 20 years is, helping build tools, using their data, and just even listening to their podcast on a weekly basis. They touch upon things that make you think. So whether you're a portfolio manager or a special servicer or a borrower, it's free. You can get it on, through the website or whatever, or the Apple, stuff. It's just, I love that it thinks outside the box. It's strategic. And so, Howard, like you said, working with tenants, that the trifecta and, quadrangle here that we have, I just love it. It comes from all different angles, and we're working to make the market efficient, and help advise those borrowers, or whatever angle we're looking at it. We need our industry to succeed. It's been a great industry, and it's kept a step ahead of regulation, and yet it's been efficient and a great place for people to infuse capital. So keep the market liquid. So with that, I've helped, call me, find us at Stack Solutions. We're happy to help in any ways, or get you to the right person to help you.
All right, Jody, I don't know if you're qualified to get you with your crystal ball. I didn't tell you I was going to ask this question. You have any thoughts about what CMBS is going to be like and going on in the next 6 months to 12 months? And hopefully you'll be on this show again in 3 months, and then we'll go back and check it out and see how well you did.
Well, that puts a lot of pressure on me, but I'll try my best. Firstly, I do want to thank Stacey for highlighting TREP and TREP podcast because I feel like where we fit into this market as a company is to provide the data, to provide the data to everyone who needs it and every sort of data that you need it. As you people who use TREP know that we have like hundreds and hundreds of data points related to each and every loan and each and every property. So the idea is that provide more transparency to the market that in some ways can be very opaque. You sometimes don't have any idea once you pay your monthly rent payment, what happens with the entire thing. So there are a lot of moving pieces to the market, and we just want to provide at every point all the information that can help in making all sorts of decisions for you all. Now, Howard, before I get into the point of what we think will happen in the next like 3 to 6 months or 6 to 12 months, I do want to point out what Shlomo and Stacey mentioned about the cliff and how there is a lot of masking of distress going on right now in the CMBS market. Like we know that delinquency rate is high, we know that special servicing rate is high, but we often talk about this in our podcast is that there is a lot of underlying issues with a lot of loans, with a lot of properties which haven't surfaced yet. You will see a forbearance, you will see sometimes a special service commentary notes that, that the borrower is having difficulty making payments, or there is just occupancy has fallen flat to like sometimes even less than 10%. Even though that doesn't show up in the macro level numbers that we put out, that is something that we are definitely keeping an eye on. And while I highlight this, the macro level numbers are already very high. So it is very important for us to keep an eye on what is happening at every point of the day right now, because things are changing really fast, and the issues with some of the property types are humongous, and sometimes it's just hard to relay all of that that's happening at the property level. But once you see the data and once you really do a deep dive, you can get through all of that. So now that kind of segues into, Howard, your question is what we will see in the next 6 to 12 months. So let me give you a data point. uh, we recently did a calculation on how many properties have seen a property valuation, like a decrease in appraisal value. And I would say it was 335 loans, which is only $8 billion of total outstanding balance, which saw a decrease in appraisal value. Now, why is that important? In the CMBS universe, appraisal happens at almost like the very end of the cycle, when we know that the borrower is having a lot of issues and something has to be done about it. Most of the time, special servicer is already involved and something is being worked out. Just in the past like 6 to 7 months, we have seen 335 loans being reappraised. That means that many loans already saw distress. And if you look at lodging loans, the loans which actually saw a valuation cut, 38.5, so the loans which actually saw a valuation cut of almost 38.5%. That is how much their property value reduced. So lodging, it was, we saw the impact much faster, but we haven't seen what impact could be in other property types and even the level of impact in lodging yet. So while I don't want to sound very negative, I do want to point out that it would be very important to keep an eye and see what is happening there in the next 6 to 12 months. I would say that we will see more and more distress. We will see a higher special servicing rate uh, for number of property types, especially lodging, because even if after COVID mass vaccination, everyone thing goes back to normal. The current solution has been a quick fix, and a quick fix is what it is, a quick fix. It will not last, or it will not address the long term problem. So we will have to keep an eye out on that. And that's what I would leave at it. It's a very I think politically correct conclusion. It's, let's keep an eye on that and see how it goes. But there are a lot of factors that we are looking at, and we do think there is some sort of masking of the distress in the sector right now. And yes, sorry, go ahead, Howard.
No, if there's one thing, well, Shlomo, do you want to give me your crystal ball, and Stacey?
Yeah, I just before that, so I'll give you my crystal ball. I just want to say something very quickly. So I have a team that works for me that does the various components of the process, understanding the valuation, understanding every part of the process, right? And then what I head up is I literally bring it all together with the strategy, right? And I brought Stacey on board because I don't come from a traditional CMBS background. I come from a property background, very self-taught. And I brought Stacey on board. Let me be very clear. And she didn't come work for me. I took her in as a principal in the company. Stacey has a whole separate enterprise running. She does a massive amount of underwriting, not only for BP's buyers, on new originations, multifamily side, and also on the CMBS side as well. I want to be clear. I wanted to make sure there wasn't any misunderstanding. I thought you were asking me how she fits into what I do. So just for clarity on that front.
I understand that she's the boss. You're the mouth. She's the boss.
Yeah, I know exactly. Which means she just sometimes hits, and I just keep quiet. My crystal ball is that I don't know how bad it's going to get, and I don't know how quick it's going to get bad. I think there are features put into CMBS that potentially could accelerate foreclosures. But I don't like predicting the future, because the reality is we can only go based on the past. In the past, CMBS has been very inflexible. But what we found is when they were hit with a ton of bricks, they found a way with the forbearances. And when I see a huge cliff and where people have given away all their rights, at the end of the day, the REO managers within CMBS shops only have so much sway over the process. They can't all say, yeah, I could turn that around every time, or I could realize something better. Or, for example, all the brokers, yes, brokers, guys, there's no comps in the market to back up your BOVs today. You cannot give those BOVs that you're giving to these lenders. It's ridiculous. What you're doing essentially is doing a service to your lender, and you will not get that listing because you're the one that told the lender they'll get a better value out of it, okay? So brokers need to realize that. So depending on how things work out, I think it will self-correct, because this isn't a small 2%, 3% shift. This is potentially the wipeout of pension funds, of firemen and policemen and civil servants across the country who've invested in pension funds, who've invested in companies like pension companies or different types of entities that have invested in CMBS as security. Okay, and we're about to see not only a wipeout of very rich people that own properties that lose properties, or lenders. We're about to see a thorough drill through to the little guy if we don't all get realistic. Okay, because the asset manager who makes us $250 a year does a great job. At the end of the day, he's affecting lives. Okay, I'm trying to protect my borrower, no question, but I'm always telling my borrower, you got to put in more money, make it worth their while. And if people just step back and realize that the system is so intertwined, right? We're all a capitalist system until we don't want it to be. Then we want to be socialist when it falls apart, right? But when the system is so intertwined that pull a thread and it'll fall apart. I mean, take a look, and I'm just going to, there's one little thing to ponder. Look at the biggest holders of mall companies. We all say malls are dead, right? Look at the biggest holders of all mutual funds. Think about that for a second. This industry, the whole real estate industry needs to wake up, the whole financial industry, and wake up and realize we're not just playing with money, we're playing with people's lives. And again, my job is to protect the borrower, be very clear, and I'm not trying to sort of conflate the two. I'm just saying we need to be realistic. I'm always realistic. I tell them, Bar, you got to pump in money because that's the only way you reestablish your equity. The special servicers, the CMBS market, the BP spires, they can't say, I don't care. I go on my yacht and I'm good. They need to recognize that their bills are paid by hardworking people, and they need to be careful with what they're doing.
Shlomo, so why don't you tell us how you really feel?
I don't know if I really want to do that because
okay.
I mean,
it sounded like that to
me. Show, right? It's a family show, isn't it?
Yeah, it's a family show. Stacey,
no, it's in it.
Do you have a crystal ball that's the same or different from Shlomo's?
I think what I see that's different about this cycle than it was the last time is, we were all waiting, like we had, liquidity issues, and now it's not even keeled. It is some of what Shlomo said, and it's highlighted on the TREP information that it's not hitting everybody the same. But what is interesting is as we buy into the new deals, and I think that's kind of indicative is the way things are structured now, because we're a little bit, we react, is that you're really seeing things focus on the next 36 months, and any type of pressure point as it has to do with any type of ability for a tenant to either fail or to retract, or what does that supply and demand look like in that market, because there is just so much uncertainty still. I know we are still saying it's temporary, we will come back, but he's right. It's because it's hurting all the way down in some markets to the hourly worker that's paying their rent on their apartment and can't, which then is, my husband's also in the industry, and he was talking about some Fannie foreclosures, and how they quickly went from modification forbearance to a foreclosure. And he said, wow, I said, there's got to be more to the story. But I think that's what's alarming to me is I expected to see collection issues a little earlier on. And what I'm seeing across, Texas, I only say that because we're open to 75% in most markets, is that we are now seeing delinquency rise. And it's because, there are these protections in place, which are needed, for some tenants, but ultimately that means delinquency is rising, cash flow is falling, which again affects the loan payment, which affects the long-term plan. Now, I guess the question all comes back to which goes back to Jody's point initially, and that is we have to watch and see what is changing month to month, because as much as we may think New York's going to open in February, is it really? And as much as we may think that the vaccine is going to, solve things, it just helps create maybe a little less uncertainty. We still have so much uncertainty and volatility, as we've seen with GameStop and everything else, that, is not necessarily trading on market fundamentals. So getting back to what Jody demonstrates in TREP, what the plans that Shlomo puts together with the strategies, we've got to build them on the market fundamentals and the 5 pillars that build up that value and level of confidence in the certainties that we can. And I think that's, I don't know if that's a long way to say that my crystal ball is still foggy, but I think 36 months is very foggy still.
The 36-month comment is really important, and I think a lot of people were thinking 3 months in March. Mm-hmm. And that's the scary thing. And instinctively, I was going, this is going to be a lot longer than what most people are thinking. Mm-hmm. It just didn't make sense to me from what I was seeing that this was short. Jody, if there's one thing that someone should take away from this discussion, what should that be?
I think, I think it goes back to my earlier point is that while the numbers, especially coming out of TREP, look high, in some ways they're not high enough. And we have to be really vigilant of how the underlying fundamentals are, rather than just kind of believing that this will all just go back to exactly as it was. Just taking one number, delinquency rate is not going back to 2% for a long time. And I use that number because I put that out. So it is very important to be very vigilant, and just on a regular basis keep track of what trends we are seeing. And while everyone knows about lodging and they understand that people are not going to hotels and making reservations, they're not taking vacations, we also have to understand that multifamily delinquency rate might be low right now, but that's not going to continue being the case because there is, eviction moratoriums and how all of that will impact it in long term. So there are a lot of like I would say balls up in the air, and it's hard to catch all of them at the same time. But that's what we all have to do in our profession. Yeah, that's what I would say.
Stacey, the one thing that someone should take away from this conversation.
Get back to basics and look at the basics that cause a property to perform. Because you can put debt on anything to amp it up. And cash, people have cash, but if a property fundamentally cannot support itself, then what good is any kind of debt that you can put on it? What does your return mean if you don't understand the fundamentals? Get back to basics.
Shlomo, the one thing that someone should take away.
I think the one thing I'll quote Donald Rumsfeld. There are knowns. There are no knowns. There are things we know we know. We also know there are known unknowns. There are things we know we don't know. But there are also unknown unknowns. The ones we don't know we don't know. We don't know what we don't know right now. We really don't know. And I think running scared is not the right approach, because as a market, we create the market, right? It's just how free markets work. If I buy, you have a way to live. But at the end of the day, there are so many moving parts in play, and it's impossible to predict. So, and I'll say one point. Even Trepp, Jyoti will tell you, the data that's being provided is sometimes flawed as well, and it's for various different reasons. And I'm not going to go into the war stories now, but so all I'd say is, like, you need to tackle what's here and not assume based on a projection. I've heard New York City is going to open next week, in 2 weeks. I've heard, Dallas is great. You just heard Stacey will tell you about delinquencies and properties that she asset manages that, or properties that are on the market. People are buying crazy prices that they don't realize these delinquencies. So the reality is we all have unknown unknowns. And I think as long as we adhere to that, when we focus in the moment, we can work to fix it as opposed to figuring out how to maneuver it.
My one takeaway, what I took away from this conversation, first of all, this was a great conversation. But my one takeaway is I didn't realize how smart I am by surrounding myself with people smarter than me. I'm sitting here going, what you think I was going to say? The truth of the matter is I am wowed by how smart and how knowledgeable the three of you are, and that you're more knowledgeable and smarter than me, which makes me feel really smart that I could surround myself with such smart people.
I think here's what I say. If I leave, the IQ will go up a bit. I think that's where I put it in.
Well, hopefully you'll rub off and everybody will listen to the three of you and go, boy, is Howard a smart guy.
No, thank you.
Howard, thank you for giving us your time, and I do think this is a great group. It comes from all different perspectives, and I just appreciate very much bringing us together.
Well, you got to thank Shlomo for bringing you in, and this was a wonderful. I am going to market this.
What she said.
Yeah, what she said. Yeah, whatever she said. There you go.
Yes.
And Jyoti,
great meeting you.
Jyoti, thank you very much. Stacey, great meeting you. You were wonderful. And Shlomo, you're okay. I can't get the bathtub picture out of my head.
Well, live TV, it's a family show.
Oh, God, I'm going to send you a picture.
Oh, no, that's okay.
All right, everyone. You take care. You have a great weekend. Bye-bye.
Thank you.
Thank you.